So welcome. This webinar has been put together for companies globally, really, for assistance and a bit of a Q&A on the UK-China corridor specifically. I'm sure if you are dealing in these regions, you will be aware of some of the obstacles that we have to navigate. And we thought we could bring together some of our knowledge to share with clients and prospective clients, and just try and run through as much information as possible, trying to make it as clear and simple as possible. So yeah, that's the plan. Bit of background: I'm Maxim Sin, one of the heads of desk here at Ebury, running a team of business developers. We have quite a few on the floor. We originally, Ebury started in 2009 with Juan Labarto and Salvador Garcia. And the idea then was a FX brokerage, quite simple, really. And since then, I mean, crikey, that was quite a while ago. A couple of hundred employees, 2 or 3 offices. I joined around 7 years ago now. And since then, we have grown to, wow, about 1,100 employees, 23 offices in about 20 different countries, $23 billion transacted in the last financial year. And then more recently, Santander acquisition of us of 50.1% for £350 million. So the growth has been pretty crazy in that time, but we're not stopping there. More countries are being added, and more capabilities, products, etc. We're not just an FX brokerage. We developed a trade finance product to help the SMEs that we were servicing initially. And then acquisition of Frontier Pay to help with mass payments, and it's just spiraling really in the good direction. So how we've got to this point, I mean, a lot of our business, as you can imagine, with cross-border currency, we're dealing with businesses that are purchasing from China, and the issues surrounding that and how we can help navigate that. So we tend to try and find and listen to our clients and see where there are problems. And what we've done here is try and build solutions to take a little bit of that out of your lives. Your sole purpose is to run your business. That's what you've specialized in. That's what you do. So if there are things that you can, I'm not going to say outsource, but we can assist with and take some of that load off you. Why would we not? It's just an additional service, which means that you would appreciate using us, and it's efficient and works well. So we're going to run through, really kind of take you through the journey. So first of all, we're going to have Ting, who's going to work, and she's part of Crayfish, and she's going to go through the general Chinese landscape. So this is like, why would I be trading with China, and what does this landscape look like? Of course, a lot of you will be aware of why you're trading there and how it works, but this will give you more of an overview as to what's going on, what to look out for. Of course, you're aware of a lot of things that are going on, but what's upcoming? What do we need to be aware of? After that, we will pass across to Isabelle, who runs the China-UK corridor, supplier liaison, that area. And that's more, the nitty-gritty. How can we navigate this landscape? How can we, methodically run through this and find a way to navigate through it, really? And then after that, we'll have Richard Atkinson, who's a senior dealer here at Ebury, who will deal with the financial aspects and the latter point in once Isabelle has gone through everything, we will then deal with clients. How does that look going forward? So that's the program, that's the format of what we're going to do. And throughout this, I'm sure you guys are going to have questions and thoughts that are going to spring to mind. Feel free to pop those into the Q&A button at the bottom, if you can see, and we will run through those at the end of the webinar. So that's the plan. So I am going to pass over to Ting now, who will be able to take you through and cover her area. Cheers, guys.
Thank you, Maxine, for the introduction. And hello, everyone. It's nice to see you virtually this beautiful autumn morning. So I'm going to share the screen now while I speak. Right. So as Maxime mentioned, I'm going to give an overview of what's happening in China with the Chinese economy, and also what's the implication for you doing business with China, whether whatever is import, export, other activities, what's the implication, what you need to think about, and what can you do more to achieve that. And just very quickly about myself and how I got to here. So I actually was born in Sichuan, where pandas and Sichuan food, and then educated in Shanghai. So that's the landscape in 1992. It's very different from now. Then I worked in Zhuhai, which is a city across Macau, and mainly in export, import, and joint venture. Then worked in Hong Kong for 3 years, just across where Hong Kong was handed over to China. Then decided to leave China to study, and I came to Cambridge. And then after my degree, I worked in the city of London on trade finance for a couple of years. Then with my new family starting up, I came back to Cambridge and started my first business, which was a China-focused consultancy. And during those about 15 years, I worked with many British companies, starting with tech company, but then later to manufacturers, and also engineering companies, finance companies, all across UK and also US and Europe, also work with government agencies. But during those time, I wanted to have a better mechanism to help SMEs trade with China with more efficient way, so that it's not the kind of consulting model, but more in line with what's coming up, like the shared economy, sort of Uber style, and the sort of digital way. So that's what Crayfish is about. I will tell you a bit more about later, but I also have various roles to promote better understanding between UK and China in my various voluntary roles involved at a national level and industrial level between UK and China. So what I would like to talk about, as I mentioned, start with the sort of economy overview, but then look at a bit more about the trends, and then the recent regulation changes, what this means for various sectors, and then also how to get out of the trade with China. Starting with the strategy for China. So what China is doing now is after a rapid growth of the past 2 decades, in fact, China doubled its GDP in the last 10 years. And what China is good at is long-term planning. That's one of the advantages of being a country where the government is very much involved in planning economy. So in the next 15 years, what China wants is high quality growth. It's no longer just pursuit of GDP, but also balancing act fairness and efficiency for the society. So if you look at the GDP, of course, now is back to pre-pandemic and even higher. But the latest figure coming out this week is that this quarter's GDP actually slowed down to only 4.9%. But that's okay, because China is no longer pursue, as I said, just fast growth. So one of the things that you would need to be aware is there's a big shift of the economy model, in that the government wants to reduce reliance on foreign markets and foreign investment, and more encourage the sort of domestic circulation, the dual circulation, which mainly means that there will be more consumption-led growth, which is probably means that there will be more demand for foreign products into China, while the government is still encouraging export. And then I mentioned the sort of fairness, so that the government's latest advocate, and if you haven't heard, you probably will hear many times coming up, which is called common prosperity. This is a phrase used by President Xi a lot, and also by the government. So what it means is it's basically bringing those poor areas and those people who are under $150 income per month, to bring them to a better quality of life. So particularly in the rural areas, to revitalize that. And China is the world's biggest place for billionaires, but still almost 40% of the people in China still sort of in a poverty area, not absolute poverty, but still poverty. So finally, China is pursuing a sustainable growth, and it's very committed to climate change and carbon neutrality by 2060. Again, that's created a multi-trillion industry in China, and that it doesn't matter which industry, whether it's new materials, whether it's engineering, whether it's consumer goods, anything that helps the country reduce its carbon input is really going to be working very well in the market. So a little bit on the sort of digital trend. So this is actually an article from McKinsey. If you're interested, you can read in more detail with the link later. You're going to get PowerPoint. And essentially, China is leading on the sort of omni channels for the retail, and also there's a lot of more services, not just B2C, but B2B services are being virtualized, going online. And there's this, China is the first country to launch the autonomous driving taxis, and the robot is used a lot more in industry, manufacturing, and there's a massive urbanization going on now with smart cities spanning all across China. So these are the sort of general trends, and this means that if you are going to do business in China, you need to think about what this means for your supply chain, and if you're setting up there, what this means for your business structure. Do you need to reorganize them? So I mentioned the sort of digitalization of services, and while before it was more about shopping, food delivery, but now it's more about business to business, and this was particularly the case during pandemic, and now the trend is here to stay. So while before, even as a customer, you may still want to go to China quite a few times to maintain a relationship or maybe get a better deal. But now you can do a lot more this remotely, partly because you can't travel. But even in China, people are turning more to do this remotely, and that's really good for everyone involved, environmentally, but also more efficiency. And sorry, so probably all know this two people, particularly you probably know Jack Ma on the left. Not many people know Pony Ma on the right. So these two are the biggest personality for the Chinese internet or mobile industry. But you may not know that they too actually own the two completely different empires in China in the digital space, and they are very different, and they exclude each other, and they basically encourage you to deal with the other if you are their customer or supplier. So what the government has recognized is this is actually antitrust, but also it's not good for the consumers. So as a result, the government starting this year, almost every week, or at least every 2 weeks, there's new regulation coming out, targeting all this kind of antitrust behavior, improve better business practices across industry. So start with tech, I mentioned that, with Alipay, with and finance, but then later also education, and now in terms of the other digital industries, and recently data privacy, data security has been a big change in the industry. It's infecting directly, impacting those companies that needed to get data out of China, and the way how they share the data, how they collect the data, particularly with the use of the AI face recognition, which is rampant in China for everything. So now the ripples are going through other industries, starting every week a new one. Last week was media, before that was banking and healthcare. So more to watch if you are looking to to do business in China more, into the market. You need to be very aware that regulation has a direct impact in how business is done. Right. So I understand some, maybe most of you are sourcing from China, and some of you are manufacturing in China. Potentially, maybe you're looking at selling to China, but more for exporting as well. But China is a big export market, which we're going to touch upon. But you can also carry out R&D with, China is producing millions of engineers every year, and it's a very good source for doing that. And finally, not least, China is now becoming more and more source of investment, whether it's for minority stake or whether it's M&A. And if you're thinking of, exiting your business or seeking funds from China, you can also actually look at that seriously. Of course, China's big. If you look at it geographically, it's very similar to American in size, but the market is really very much diverse across different cities, different tiers of cities where the consumption power is different, but also the purchasing behavior is also different. So is it easy to do business in China? I think it's easier now, but it's still difficult because it's cultural, language, and among other things. So China is actually now ranked at 31st as across the world as to how easy it is to do business in China. I mentioned there are different tiers of city, but there are also different pockets of the sort of economic development. As you can see, the data, the triangles, are the more advanced developed areas. On the close coast areas, having benefited the last 3 decades of open economy. But on the west side, the sort of Chengdu-Chongqing economic circle, which was only announced last year, provide a lot of opportunities for not just selling, but also look at manufacturing. Advanced manufacturing is also traditionally being very good engineering capabilities there. So there's still a lot of challenges, from culture to cost of acquiring customers to IP protection, but more so now with the with the COVID situation, this has some of the challenges has gone worse, particularly managing your overseas supplies or customers remotely, and without access to the talent you need who can speak your language, both languages. And now with the travel and supply chain bottlenecks probably bring a much more higher cost, as we know, with the freight, but also with other things. But foreign exchange, of course, you're sorted with Ebury, but that's still one of the challenges for other companies. So here I just wanted to very quickly just to say, if you are doing business China, and culturally, it's very important to know all those aspects. And the sort of hierarchical structure of Chinese culture means that you do need to deal with the government, the sort of top-down approach always work better. The sort of little picture on the right top, where it has Chinese character, this just means party A and party B. If you are an importer, so for Chinese, you are the party A, which means you're a customer. So you most likely, are getting more respect. But if you are a supplier in China, typically you are at the bottom of the hierarchy, less bargaining power. That's the sort of Chinese implicit business sort of relationship is which are you party A, party B. So typically in China, party B, which is supplier, would have to wine and dine the party A, not the other way around. So it's kind of cultural that it's quite sort of taken for granted. But you do need to be flexible, because the Chinese people are very flexible in terms of doing business. Doesn't matter the contract is signed. If they think situation changed, they'll come back and say, sorry, I can't supply anymore because of this, that. Doesn't matter if I signed a contract with you. So be prepared for that. But on the other hand, you can use that to negotiate your own terms. So you can say, okay, that's all right, but then you need to give me a reduction next time. You need to give me extra volume of goods. You need to do some other concessions. So negotiate always to your own advantage. of course, most of you, if you have been doing business in China a long time, you've already probably got quite a good relationship, having some multis when you go to China. But the numbers are also important. I just want to mention that red sort of numbers. So 8, 6, and 4 is very important in China. So if you are negotiating pricing, sometimes you can actually get a better pricing if you go for those numbers first two, not the last one. Last one, 4 means death is a number to avoid. Okay, so and you probably already worked with Chinese partners, but if you're starting from scratch, you need to consider due diligence. Don't just go for a company who someone just come along by email or whatever, because there always may be someone who's better suited for you, and that's important. And particularly if you go to import and export fair, there's hundreds, thousands of companies who can say they can supply you. So who do you go with? You can be swamped. So it's good to have due diligence. I actually started going the Canton Import and Export Fair in the early 1990s when I started working in China. And now it's very different from then. Those days it's more dominated by the sort of national and regional state-owned companies, while now there's a lot more private companies. So it's also giving you much more flexibility. So does size matter? This one is really, if you're a small company dealing with a massive Chinese company, can be daunting. So sometimes it's better probably work with companies that are smaller, but then will take you more seriously and give you better treatment. So this one is just to say, if you haven't started selling to China, maybe consider, because China is the world's largest market for almost everything, and so that's something that could be bring you extra revenues in the coming years, particularly with the Brexit. That if you're selling to Europe, it's as complicated now as China. So why don't you sell to China? At least there's one border, one custom to deal with. Right, so no matter what you do in China, whether you are exporting, importing, or manufacturing, really you've got to protect your IP, because even you're not selling to China, someone saw your brand for somehow, and they might register first, because China operates on a first to file rather than first to use. It's very important to do that. And if you do have a Chinese trademark, do register that as well. But if there is a problem, someone actually infringing you, don't let it go, just pursue it. There's various ways you can do. And then even if you are you have a negative, you have a outcome that's against you, you still can appeal. China is now making huge progress in its legal system in how it's dealing with the sort of intellectual property protection. So I would suggest you look into that. So now, very briefly, this is what Crayfish does. But as an example, there are other platforms there, probably also offering business services. But Crayfish is the only one that's dedicated to helping companies to trade with Asia, particularly on China. And whether you wanted to find someone to call China or do due diligence or marketing or having someone inspecting your China, we have what Crayfish does is we have standardized these services and make them like Amazon style. So we have vetted providers who can deliver to you, and we guarantee that service. So you can budget to say how much it costs you to do business with China, to start a new endeavor to do Chinese business. And then there's also the gig economy. As I mentioned, in China, there's a lot of talent, and they can do business for you in a tailored approach. We have, for example, people who wants to find new supply in China, or wants to find manufacturer on the license, or dealing with supplies. We had a company that did a mold with a Chinese company, and when the products sent over, they were totally not suitable, and then the Chinese side just gone quiet, don't dealing with any inquiry. So the client found us. Within 24 hours, we find a lawyer in the same city who went to knock on the door, and then the second day, the Chinese supplier actually talk to the UK client again and then sort it from there. So you do need sometimes to resort to local resources to do that. And that's all from me, and we would love to support you with Ebury, with others, to support you to do business with China. This is a fast train. I took the speed train when I was there just before the pandemic. And I hope that we can all visit China soon as well. Thank you very much. And that's all from me.
Hello, team.
Appreciate that. We're just going to pass across to Isabelle now, who can run through her area.
Hi, everyone. So thanks a lot, team, for a great presentation. And now I'm going to be sharing with you about the nitty-gritties as an importer that are buying from China, the possibility of negotiating prices in RMB with your suppliers. So this is a project, the RMB initiative, that we started pushing at Ebury since 2018. And I'm very happy to share that throughout these years, we have actually successfully assisted over 1,000 clients and their suppliers in China to be able to transact in RMB. So I want to first start the presentation by setting the stage and explaining what are the different denominations of the Chinese currency. So the official name is RMB, which means renminbi yuan. But then actually in the foreign exchange market, you're gonna see the RMB showing as CNY and CNH. And given this is a terminology that we're gonna be using across this presentation, I wanted to briefly explain the differences first. So when we see CNY, that means the Chinese currency that is traded only inside mainland China. That means excluding Hong Kong and Macau. So this is not a free float rate, but the daily rates are fixed by PBOC. And then the daily exchange rates cannot move beyond 2% based on that fixing rate of the Chinese central bank. So this is only deliverable inside China, and only if you're a financial institution that is present in mainland China, you can tap into the local CNY liquidity. Then for companies that are outside China, historically, you usually look into the non-deliverable version of the CNY, which is free float, but then this was only settled in USD. You couldn't settle RMB directly. So that's why a few years ago, it was introduced the CN8. So this is exactly the equivalent of CNY in China, but it is traded outside China. It's fully free flow and it's deliverable fully outside China. So how this works is that as an importer in UK that is planning to pay in RMB to China, what would happen is that from Ebury, we'll be able to help you pay in CNH, but once the CNH crosses China's borders inside mainland China, it will directly convert to CNY at a rate of 1:1. So having said that, throughout my presentation, I'll try to refer to the Chinese yuan as RMB or yuan, except when we're showing the trends in the currency market, which I'll show it as CNY or CNH. So we wanted to give you a snapshot on what has been the fluctuation of the dollar CNY rate in the last 10 years. And while previously the Chinese suppliers have mostly been exporting in USD, this might no longer suit to the current situation. The reason is also because we've seen how the Chinese authorities have been pushing more and more for the internationalization of the RMB. So some of the major highlights here is in October 2016, when the RMB actually became part of the basket of currencies of the International Monetary Fund. And we saw how since then, we have been seeing more and more double side volatility on the dollar versus CNY spot rate. This is something that wasn't happening previously because the RMB was pegged to the USD. But since 2016, we have seen how there's more and more peaks and buttons on the exchange rate. So I've highlighted here a few. In April 2018, we saw the dollar RMB drop to its lowest level, which was $1 could only exchange for 6.25 CNY. And then in August 2019, because of the increasing trade tensions between China and the US, we actually saw the RMB at one of its weakest level. So $1 could exchange as much as 7.15 CNY. So between this lowest and highest level, the RMB has been fluctuating versus USD almost 15%. And that obviously will also have an impact on the prices that your suppliers in China will be providing you. So another factor that recently it's also hitting a lot the prices is regarding the recent power crunch in China. So as all of you are probably aware, so the Chinese President Xi, has committed to become carbon neutral by 2060. And because of all this high pollution in China, because of the factories, so recently the government has started to limit the amount of electricity that each factory can use. So that right now they cannot run at its full production, and normally they can only be working for between 2 to 5 days per week. So we foresee that this is going to create additional pressure on the cost of the raw materials. And actually, the foreign exchange impact is also going to magnify this effect. So here we have just given an example. Let's assume that if the material cost has increased by 40%, then that would mean an impact of 40% if it was only the increase in raw materials. But then if we add that with the appreciation of the RMB by 10%, then in total, we're gonna see a cost impact of 54%. So that's why by removing the impact of the foreign exchange, that's also gonna help you to somehow mitigate the impact of the increase in raw materials costs and also the increase in freight costs, which is two things that we cannot really do much, but we can do something more regarding the foreign exchange. So that's why we see that more and more buyers and their suppliers in China are actually turning to transact directly in RMB. So the benefits of this from the supplier side, it's mainly that they will be able to protect themselves against the negative impact of the dollar RMB exchange rate, because as all of us are aware, the RMB has been increasingly strengthening, not only against USD, but also against the major currencies. And obviously that would impact on the prices, and that would also mean conversations between the supplier and the client asking to further increase the prices, which obviously the supplier wants to try to avoid and then keep good relationships with their clients. So on the buyer side, the benefits of directly paying in RMB to your suppliers are first and foremost that you're gonna be able to ensure that at least your prices are not gonna get impacted because of the continuous appreciation of the RMB exchange rate, and that you're gonna be able to protect yourself against what we call one-sided risk. And this is something that I will further elaborate in my next slide. Also, by directly paying into RMB with your suppliers, you're gonna ensure that you can directly access the base price of your suppliers, because most of the suppliers, they have their cost base in China because the factories are there, the production is there. So they will always use RMB as the reference, and they will convert it to USD to export. So by directly paying into RMB, you can get more transparent prices, and you're also able to have a say on how the foreign exchange is being managed. And of course, for both parties, we are avoiding the hassles of a double exchange if you need to exchange from sterling pound into USD, and then the supplier needs to exchange from USD into RMB. So by this way, we can directly do one conversion and directly the client can convert their sterling pound into RMB and pay to the supplier in China. So here we want to illustrate about this one-sided risk and how is that impacting the prices for the buyers. So you can see the evolution here of the dollar CNH exchange rate throughout 2020. So let's say this is a supplier that you're working with that fixes prices at the beginning of each year. So normally how the suppliers fix their prices in USD is that they will use a reference exchange rate dollar RMB that is normally slightly below the current market rate to ensure that they have a buffer for small fluctuations in the exchange rate. So this exchange rate that the suppliers have been using before the massive appreciation of RMB last year was actually 6.8, because throughout 2018 to 2020, this was the case that most of the times the dollar RMB exchange rate was above 6.8. So they were using a rate of 6.8 to convert their RMB prices into USD. And we see that at the beginning of last year, the actual exchange rate was actually 6.97. And to make it easy, then let's just assume that the supplier had a base RMB price of 697, right? That they were not even putting any buffer, they were just converting at the current exchange rate. So 697 yuan, that's what they're expecting to receive. So they convert at current rate of 6.97, and then that comes up with a price of 100 USD, right? Which is the price that the supplier would be selling to their client. So we see the evolution of the exchange rate throughout the first and second quarter of 2020. So actually we see that the exchange rate at that time, RMB was still weak against USD. And then the supplier was not only getting the 697 yuan equivalent that they needed, but they were even getting some more additional margin because of the favorable exchange rate. So we took May 26, when dollar RMB was at its highest, 1 USD would even exchange for 7.17. So what that meant is that the supplier expected to exchange for 697 yuan, but then for every 100 USD that the client was paying them, they were receiving 717 RMB. So that's all like extra margin that they've been getting, which we're illustrating in the gray bubbles at the bottom of the page. And at that time, if I ask a lot of you if the supplier actually decreased your prices at that time, I'm sure that the answer, like most of our clients, is no. Like supplier actually kept the prices stable at 100 USD. The client was happy because prices were relatively stable, and supplier was even happier because they were getting the full upside of favorable exchange rates. But then this situation didn't really sustain for very long. And starting in July, we started seeing how the RMB was increasingly appreciating against USD, and then the exchange rate started dropping. So in September 15, 1 USD, not only it could not exchange for 6.8, which was the budget rate that the supplier had, but it even decreased further to 6.75. So that means that the supplier was actually losing money because the exchange rate moved beyond their expectations. And obviously, because most of the suppliers in China, they don't actively manage their foreign exchange risk, and they don't have hedging tools in place, they were completely exposed to this unexpected negative impact of the exchange rate. So what they did is that they actually asked our client to increase their prices. So now the USD price was no longer 100, but now was 105. And this was not only like the negative impact of the exchange rate, but our clients had also to bear with the increase in the freight costs and also increase in raw materials. So this was just adding up. And the problem that we have here with the foreign exchange, as you're seeing in this illustration, is that when the exchange rates are favorable to the supplier, they're actually getting the full upside. But then when the exchange rate starts dropping, as we're seeing. So September 15th was 6.75. By the end of last year, $1 could only exchange to 6.5. And right now, $1 could only exchange to 6.39. So because of this situation, the supplier has been increasingly increasing their USD prices. And a lot of suppliers that we talk to, they're even directly saying, look, now we cannot fix prices for a period anymore. For a lot of clients, every time that they place an order, the supplier will look at what is the current exchange rate and pass the full FX risk for our clients. So our clients is still paying in USD, which are increasing day by day, but they cannot really do anything about the indirect effect of the RMB, which is the one that is creating the negative impact. That's why we feel that it makes sense for the client to be able to control fully the exposure of the RMB and then the impact on their prices, and directly ask for RMB prices with their supplier instead of continuing with the USD prices. And this is something that from Ebury, we have been actively assisting our clients to negotiate with their suppliers. So explaining to them why it is good for both parties to pay in RMB, what are the implications, and what is the procedure that they would need to follow. And this also brings up to the common issues that through our conversations with the suppliers, we have identified that they normally raise with the clients. So the first and most common one is a supplier mentioning about tax refund issues, that if they receive in RMB, they will lose their tax refund, and therefore they're gonna give increased prices in RMB to our clients. So how, what is the supplier referring to here, right? So this is in most of the cases a misconception. How this works is that all the goods that are manufactured in China, they're subject to a VAT, which can be up to 16%, 1/6, depending on the product that they're manufacturing. So on average, this is normally 13%. But then when the suppliers export these products abroad, they can claim a rebate in the taxes with the local tax authorities. So a lot of suppliers have this misconception that if my clients pay me RMB, then maybe they will lose their tax benefit because RMB is a local currency. But actually, this is not the case. Based on the Chinese regulation, and also because the authorities want to promote the international use of the RMB currency, since a few years ago, the cross-border RMB is equal to a foreign currency, and as long as the supplier is receiving RMB from outside China, this has the same consideration than USD, and the supplier can equally access to VAT rebate. So supplier shouldn't really be giving clients higher prices in RMB because of the VAT, because they're still gonna enjoy the same benefit. Then second one is for suppliers complaining that if they start now receiving RMB, they need to do a lot of paperwork with the bank. So actually, this is something as well that the Chinese authorities is trying to solve. So at the end of last year, there was a guideline issued by the multiple Chinese regulators, where one of the things that it was prescribed is that banks are going to be able now to accept digital documents for receiving in RMB, whereas previously the supplier had to go to their bank physically, submit all the documents. Right now, it's okay for them to present the documents electronically. So that removes part of the friction that the suppliers had in the past in terms of like more paperwork because they have to work with RMB. Then another very common issue is for suppliers that have an offshore entity in Hong Kong and they're receiving the proceeds from their exports directly in Hong Kong. So this is because there is a restriction of capital movements in mainland China that doesn't apply to Hong Kong because of the one country, two systems. So effectively, a lot of suppliers would choose to set up an entity in Hong Kong because also it's very easy to receive their proceeds. So operationally, because of some restrictions for the banks in Hong Kong, a supplier cannot receive RMB directly and send RMB directly to mainland China. And Ebury, in light of this situation, we have actually developed a tailor-made product called Parallel Forward that addresses this issue and allows the suppliers to continue providing prices in RMB, but we give them the flexibility to receive in USD equivalent. This is something that I won't go into too much detail here because of the time constraints, but you're welcome to inquiry with any of our Ebury representatives for further details. So this is my part of the presentation. I'll now pass the floor to my colleague, Richard, that can share an actual example of how we help a client and a supplier transitioning into RMB. Thank you, everyone.
Hi, thanks, Isabelle. Yeah, as for those of you who haven't spoken with me before, my name is Richard Atkinson, and I work on the UK dealing desk at Ebury. So working with UK-based companies with foreign exchange risk and exposure. And Isabelle and Ting have gone into a lot of detail about the Chinese renminbi switch. So what I'm going to do now is just go through a case study, quite briefly, of how it worked in practice for a client of ours, and what the benefits were to him, and what sort of timeline it took to do that. So I'm just going to share my screen now. So that should pop up there. Yeah, so as mentioned, we'll start with a little bit about the client. So the client is a wholesaler of garden furniture, as you'd expect. Vastly over, far over 90% of their product is imported from China, ready-made, and then being sold in the UK predominantly. Again, 80–90% of their sales in the UK. There is some Eurozone exposure, but it's predominantly UK revenue and Chinese costs. They had both an FX broker and their main bank, which had been handling their FX requirements for many years. As you can imagine, they historically paying for these imports in American dollar for 20 years, let's say. So they actually had a pretty long-standing relationship with their 5 main suppliers. Really, I think even the shortest one was over 8 years, but some of them around 10 years. And even with this very strong relationship and open and good history with them, they were still exposed to 2 price hikes in 2020, which totaled about 8% on the price hike. It was going to be 10%. It was a 5% increase and then another 5% increase, but they managed to negotiate the second 5% down to 3%. Now, clearly, they absorbed a little bit of this into their margin, but the figures were far too high. So, as you'd expect, they had to pass this cost on to their customers, which, as you'll all be aware, it is far from ideal. It's whilst it might look to the people buying the products that you're making more money per product because the price has gone up. In fact, because their margin had been hit with the price hike as well, they're actually making less money for the product which is being sold at a far higher price. So that was the background. We then, our sales team, called the clients and started having conversations, at which point the client relayed to us that he was pretty happy with his current FX provider, and actually that he had hedged his sterling dollar costs until the end of 21. So but this was at the beginning of this year that we spoke to them. So he was a year ahead on his hedging, removed some of his FX risk, thought there's nothing else he could really do. We then took the discussion to RMB, and after some sort of exploratory conversations, he did understand and agree that it was worth exploring. So we agreed to leave it a couple of weeks and have a conference call. In the meantime, giving him a couple of weeks just to get in touch with his suppliers and sound them out, and sort of sense check it with them. So we then spoke again in February, and he had contacted his 5 main suppliers, and the feedback from all 5 was very positive, but they hadn't actually been receiving RMB directly, the suppliers yet. So There's a couple of misconceptions on the tax issue that Isabelle mentioned, which is outside of my knowledge base. So I organise a call between our supplier liaison team and our client suppliers. So our supplier liaison team is based in the Hong Kong office. We're very, very fortunate to have them. So they liaise directly with the suppliers, and obviously this removes some of the potentially cultural or language barriers that Ting spoke about earlier. They contacted them over WeChat, and they clarified that there would be no loss in the VAT rebates. And the discussion, moved to the sort of the general topic, which is obviously very prevalent in China, and more so over here now. That the Chinese government is incredibly keen and is pushing RMB globally now. So the whole chat was not that it was just about now, what the supplier wants now, but also about moving it forward in the future and being ready for the change that no doubt is coming. So at that point, the supplier was then happy to send our client an invoice with dual invoicing. So one invoice, but with two different prices, one in dollar, one in RMB. The saving was around 1% for paying in RMB, clearly for removing that transactional cost for the supplier in China. But far more importantly, for our supplier, for our client, the supplier confirmed that if the client was to move to RMB and stay in RMB, that they would no longer be liable to FX-related price hikes, which is without doubt the major benefit to our client. Clearly, after that, the client was keen to onboard, so we onboarded pretty quickly and established a 2-year forward line so that we could work on the FX risk as well. And then, in the summer, we locked in some hedges to cover his FX risk. To begin with, we did $1 RMB for the remainder of the year, predominantly because the supplier was so keen to get the RMB flowing from our clients that they didn't want to wait till January to see that benefit in pricing after what had been quite a tough year with the price hikes. And then a more traditional sterling into RMB hedge, which we've covered now for 2022. When looking at the hedges, clearly, we look at the market and we see the volatility that Isabelle focused on earlier. But also importantly, if we look at the forecast here, we see that sort of dollar CNY is expected, dollar is expected to drop versus CNY. Whereas if you look at the sterling CNY chart, you'll see that it trades up. So not only have we seen dollar losing track against it over the last year, as you can see on that graph, whereas sterling has held a bit more, the forecast is this to be even more important. So the price hikes for next year could be even more significant. So finishing really with what are the main benefits for our client? Well, it was 4 key areas. Firstly, more attractive to his supplier. He now carries less risk as a client. That obviously, and less transactional cost, and less of a headache for the client now with having to do their own budgets and stuff in dollars. Our client has now just become an RMB price client. It's much simpler for the supplier to price him. So obviously that translated into around a 1% saving on purely on the FX cost alone passed over to our clients. He got better price stability, which was key to him after a very hectic year. COVID was a tough time for everyone, but also with the price hikes, it was really causing a lot of headaches. So his price stability now is far greater. He's giving locked product prices for some of his products for up to 2 years, not all of them, but a vast majority, as long as he maintained to pay in RMB. So his budgeting was much more clear and able to be significantly more accurate. Clearly, we removed his FX risk because there's no point in doing all this if we're not able to sort of reduce risk on multiple levels, not only price but also the FX. We're happy to give him a collateral-free line on a 2-year forward initial deposit of 0. So he was very happy with that. We're able to move the risk without tying up too much collateral. So yeah, that was it. But clearly the most important benefit to him was removing the price hike. So I think it was something that, in all honesty, was was probably keeping him awake at night a little bit. You know, he'd absorbed 8% this year. I think he was dreading what was going to happen sort of January, as when we spoke to him in sort of the summer, what was going to be happening around this winter, and what was going to be happening at the beginning of next year. And I think he was worried that if they came for another 5-10%, he really would not be able to sort of keep going. The margin would get smaller, and would be passing on to the consumer the whole time. He's now actually turned that into a positive for himself, because I think he feels that when the next hikes come, that he will be in a position that not all his competitors will be in, where he will not get the same level of hike. There will still be some hike, raw material hike, but he will be certainly able to be more competitive than others. So it's given him, really, at a time of huge volatility last year and huge uncertainty globally and in the currency markets especially, moving to RMB has given him the stability that he's been looking for, both in terms of budgeting, both in terms of moving that price hike, and of course trying to eke back that little bit of margin he gave away on the price hikes. He's sort of got a little bit of that back straight away, but more importantly, it's not such a headache for him now. So yeah, I think, comment from him below, you know, it's changed his perception with his Chinese supplier. I think he's seen as a bit more innovative, forward thinking, progressive, all of those topics, and he's actually opened up something to the Chinese supplier as well, who are now exploring other people paying him in RMB. So that's a very brief guideline. Most of those benefits are pretty universal for our clients. You know, huge amounts of our clients have seen these price hike problems when paying dollars to China. So it's pretty universal. But that's it from me. So I'll pass back to Maxim. But thanks everyone for listening.
Thanks, Richard, for that. I know we're short of time, and I don't know if anybody has any questions that they haven't put into the Q&A. But just very, very quickly to summarize, I know Isabelle's was pretty in-depth, and I know for myself it took a little while to get my head around how it all worked and the dynamics of it. You know, the point of stress here is you're not doing this on your own. We, with our supplier liaison team, will go and do the fact finding, find as much information as we can, and then sit down with you and help to formulate a plan, speak directly with suppliers, and we try and take a lot of that load off your plate. So, you know, if you haven't had the conversations yet or in the process, you know, bear with us, and you know, we'll keep you alongside us throughout this whole period. And yeah, look, I hope that was useful for you all. And what we're going to do is, you know, circulate the video. And then in addition, if you do have any extra questions or anything you want to raise or delve a bit deeper, we're here to answer any questions after that. Just, you know, pop an email, give us a call, and yeah, we'll circulate all that in an email. So look, thanks a lot for your time. Appreciate that. And yeah, cheers.
Thanks.
Yes, thank you.